Hi, everyone, and thank you for joining us today. As the spotlight on ESG issues continues to increase, today we will be discussing how companies can navigate ESG regulation and expectations on a global scale. My name is Jurgita Ashley. I co-chair Thompson Hine's Public Companies Group and our ESG collaborative, and I also currently serve as president of the Ohio chapter of the Society for Corporate Governance. I'm thrilled to be joined today by two ESG gurus, Courtney Camlett and Merv Kagu. Courtney is Vice President, Group General Counsel, and Corporate Secretary at the Vontier Corporation, where she's helping the company navigate the ESG landscape. Merv is the head of ESG and also leads the ESG and sustainability practice at Cobalt Estonia, where she's advising companies on ESG-related regulatory compliance as well as risk mitigation. So super glad to have you both here, and we're looking forward to learning from both of you. A few administrative matters before we get started. We will be offering CLE credit for this presentation, and we'll be announcing CLE code towards the end of the presentation. Please make sure to complete and submit the CLE form. It's, in essence, in a form of a survey monkey. If you have any questions during the presentation, please put them in the chat box, and we will address as many of them as we can. So with that, let's get started. So Courtney, we have the SEC's climate change disclosure proposal, we have International Sustainability Standards Board proposal, all kinds of proposed regulation in the EU. How is your company with global operations navigating all of that?
Well, I'll say there's no shortage of nighttime reading material for me. You know, with all of them being proposals, with the exception of EU at this point, we've done a lot behind the scenes in terms of looking at charters, looking at our work plans to see what might need to change. And so that I've been doing without sort of involving the board. We're in the process of actually building out our ESG program. We went public in October of 2020. So we're still a fairly new company. And we have a pretty aggressive sustainability focus. And so, you know, we've picked some of the SDGs that we're tracking that are relevant to our company. We have a environmental and sustainability work plan where we're going to do TCFD reporting in the future. And so we've been very deliberate about how we're going to roll things out and using rigor and making sure that our data is accurate. So this just sort of adds to all of that. It is something that we continually educate ourselves on internally as well as with the board. I think it's important just to keep up to date.
Great point. And we see a variety of approaches, really mixed ways how the companies are handling it. Some are already working on draft disclosures to at least part of the SEC's climate disclosure proposal, and then conducting related ESG gap and readiness assessments. We have some companies taking another look at their ESG targets and perhaps thinking a little bit more carefully about the plans that would be needed to achieve those ESG commitments. I guess on the corporate governance side, some are also looking at board composition and reporting to reporting to the board on various ESG metrics, and also like board education on those topics. Go ahead.
Going back to the metrics, absolutely. And I think every board is asking for metrics. And the question for each company, it really does vary by company and size, is what are the appropriate metrics for your company? So that's part of what's hard, is trying to figure out how to do a continual report out to the board using metrics, and what are those metrics that you want to use.
And then if you set the targets, how do you do the progress reporting, right? On how do you show all of that to the board, and how frequently do you show all of that to the board?
Absolutely.
And then Courtney, have you given any consideration about like potentially adding another director, or like sort of building out the board's expertise somehow, so you could, should the SEC's rule be adopted as proposed, that you could say that, you know, like somebody's a sustainability expert, or somebody has like climate expertise, ESG expertise?
Yeah, we kind of went through that exercise when we did CDP reporting and sort of looked at the composition of our board and their experiences. We're not seeking out directors specifically for that criteria. You know, we're looking at a number of diversity and inclusion metrics as well. So it's not like we're targeting someone who has sustainability expertise. And we even have directors that are very knowledgeable in that space on the board currently. But no, it's not something that we're super focused on right at this time. And in part because of the uncertainty with what's going to be adopted by the SEC ultimately.
Yeah, that's a great point. The rule is far from final, right?
Yes.
Yeah, and I think looking at the proxy season, sort of just a technical reminder, like to the extent that companies will be putting more disclosures about directors' ESG skills or expertise, it might be worth taking a look at your DNO questionnaire and see whether or not you want to build it out at all to cover that information, if at all.
Yeah, or even we do separate skills assessment when the whole board did one and refreshes it, and then as we get new directors onboarding, they fill out sort of a form that's separate from the DNO questionnaire that talks about their skills.
Oh, thank you for that. That's great practice, and probably even more important with the universal proxy rules being into the effect now. All right, well, let's shift to the developments in the EU. Murph, can you give us a brief overview of what US companies need to know about the EU's corporate sustainability reporting directive, and then also how US companies can become subject to it?
Yeah, sure. And first of all, thanks a lot for having me, and hi from Europe. I work for Gobalt, as Jurgita already very kindly said, and we have around 200 lawyers, and we're active in 10 practice groups, including ESG. But maybe we can skip the promotion part and get right straight to business. So essentially, I did a quick research as well ahead of this webinar, comparing how many ESG measures were there in 2016 compared to 2020. So there's this quite well-known report by GRI, and I think EY did it together, Carrots and Sticks. And according to their data, in 2016, in the worldwide, there were 384 measures in 64 countries, and by 2020, they already had 614 measures in 84 countries. That's over a 60% increase. And behind that, I think we can also claim or thank EU, where quite many ESG reporting and due diligence measures are from. So on the slide that you see, you can see predominant 5 measures that EU has introduced. In the heart of it sits the taxonomy regulation, which might have heard of. It's as Courtney said, that she's really not sure in nighttime reading. Taxonomy regulations is a fantastic document full of 500 pages of very technical text of how EU is trying to regulate, of what are the benchmarks, or what can you be considered sustainable economic activity in the means of EU. Really quickly, I'm not going to talk very long about it, or not at all actually, in this webinar, but something we cannot ignore is Sustainable Finance Disclosure Regulation, which affects a very wide variety of financial institutions, financial market participants, and financial advisors. That essentially
and then, if I can just jump in, and it's important to companies too, because to the extent that companies have investors in the EU, those EU investors might be pushing those disclosure requirements.
Exactly, and actually SFDR, even though we're not going to talk about it today, also, as you say, affects actually non-EU companies as well, especially in the finance sector. And compared to, and I'm going to get to the good stuff that we're talking about now, but so far, from the maturity level and actually applicability level, the SFDR is considered to be as the most sophisticated and ready. But now let's talk about what we're here for. So at the moment in Europe, if you can slide back really quickly, it's the non-financial reporting directive, which will be soon superseded by the corporate sustainability reporting directive, which I will talk about in the next slide, which is still the proposal stages. But also I'm going to talk about the corporate social due diligence directive, which I'll talk in the next slides. So if you can move to the next slide now. It was a nice hint of speed up, Merv. I got it.
Okay.
So to begin with, I think it is perhaps important also to explain what's the difference between a regulation and directive within the means of the EU. So we're talking about directives this time, but directive essentially means that when an EU issues a piece of legislation, it is for the member states, that we have 27 right now, to adopt the regulation within their own national legislations. There might be some differences, and some member states, especially in ESG issues, prefer actually even to regulate a little bit more stricter than the EU has said. And from the practical experience of working really closely with Nordic and Scandinavian companies and countries, they tend to usually be the Nordics and the Scandinavians. And I know for a fact that I think it was Denmark who's also currently very seriously thinking of actually going above and beyond what the Corporate Social Reporting Directive requires. But let's get to the good stuff now. So you as a non-EU company are within the scope of Corporate Social Reporting Directive if you generate a net turnover of 150 million on a consolidated level within the EU, and if you have at least a subsidiary which is large or listed, or have a branch which a net turnover is more than 40 million. There are within to be mindful, it is still a proposal text and it's not yet been passed by the European Parliament. But the text right now says that EU-based subsidiaries of companies which are not headquartered in the EU could be exempt from having to report under a Corporate Social Reporting Directive if their parent company already reports on a consolidated level according to reporting requirements which are equivalent to sustainability requirements in the EU. However, I would not rely on this yet, because what we're going to talk about is that the Corporate Social Reporting Directive actually asks for far more than I think the laws in the US are asking right now. So what are they asking? You have to, as a business, if you fall within the scope of the Corporate Social Reporting Directive, you need to report on your business model, not only looking backwards, but also looking forwards. And this is all done through the lens of double materiality, which I know that in the US hasn't yet been introduced. So what does double materiality really mean? So it means that you don't anymore report on non-financial issues of how does the external world impact your business or business model, but you now also have to report how is your business model and business activities affecting the external world. So it's essentially what it says. You need to have double reporting on materiality issues. So also you have to report on progress statements on ESG policies and objectives. You have to explain the role and involvement of your management team in regards to non-financial issues. You have to disclose and report on what are your due diligence processes, which goes very well together with the next directive I'll be talking about shortly. You also have to, of course, disclose your non-financial performance indicators. And you also have to report also in regards to that, what are your targets and transition plans, which need to also be science-based and have reference to the IPCC reports. So it's very technical, and you cannot just write beautiful letters on the on the report, but you actually have to have numerical and scientific data behind it. You have to also have the action plan to prevent and mitigate, remedy actual or potential adverse impacts of your business. And what is very important as well is that with this new directive, EU puts a mandatory assurance requirement, which means you have to get it audited externally. And something that EU is really also trying to do, and is hopefully succeeding, is that now all of these reports need to be machine readable using SF format, and topics within those reports need to be digitally tagged. So the idea of EU essentially is that investors and the public could essentially search for ESG topics and see what different companies that are either registered or are active in the EU are doing on ESG matters. And that sounds very, very much information and what's required from you. The EU understands, and it has actually introduced or currently is drafting European sustainability reporting standards, which are not yet complete, but should really help companies to know what is the format and template of how to really disclose all of those topics. And the timeline is for non-EU companies is you have to, it will become effective in 2028 for you, and you need to report in 2029 on financial year 2028. So, and what's more fun, you probably cannot see on the slide because it's very text heavy, but member states are should also impose penalties for non-compliance, which is new as well. So let's go to the next slide.
And Merv, just a quick question. So you mentioned the timelines for the basically US companies,
yes.
But is it possible that a subsidiary of the US company could be pulled into the reporting earlier if it's like if subsidiary itself is a large company in the EU?
So that's the thing, is that I would really strongly recommend already start almost preparing on the timeline of EU companies, because requirements are, as you can see, many, and as I said as well, it very much depends on which member state your subsidiary is located. So it's necessary to really, really start preparing at the same time already that EU companies are doing.
So my takeaway from that as a global public company is to work with our financial reporting team, figuring out which subsidiaries, number of people, turnover, and then when we think we might be subject to it, and start getting an action plan together.
That's a good suggestion. Thank you. But yeah, and as I said as well, the EU understands of manifold requirements from companies, and they're currently putting together the European sustainability reporting standards. Right now, it's still very much on a draft basis, but I know that EFRAG is also putting together a sector-specific reporting standard, which should help as well companies from different sectors to align with the reporting requirements. So maybe we can go to the next slide. Oh, that's my slide as well. Great. All right. Well, essentially what it just shows the timeline, and I think on this slide we'll circulate the version that I had, also the non-EU companies there, but it just sets out what is the timeline to report, and for every non-EU company needs to start reporting, actually publishing the report 2029, but contain the information of financial year 2028.
That's great. Thanks, Mervat. I'm going to go back to the slide just for a second. So if you take a look at what the proposed corporate social reporting directive covers, right? Like it's way many topics than just climate, which is the only one, other than like talent management, which is currently being addressed in the US, right? We have pollution, biodiversity, workers in the value chain, like all sorts of things. And if you pull those draft standards and like you add them all together, it's what, like 500 pages. So it's voluminous. And we were chatting a little bit before this webinar that what's not clear right now is to what extent they will apply to the US companies. I mean, there is, I think you were saying, Merv, that there is some expectation that maybe they'll be pulled back a little bit for the third-party countries, but then at the same time, you don't know if any of the individual European countries might actually expand them.
I would really strongly still advise right now to continue with Plan A and not to expect too much forgiveness from the EU on those topics, and really start collecting data already now that you already have within your company, because the more clarity there is on EFRS reporting standards, I see less and less forgiveness towards non-EU companies. So I'd really go with Plan A.
Well, you have properly scared us now. So with that, I will quickly review the highlights of the SEC's climate disclosure proposal, and then we will talk more about international regulation and also about addressing ESG and supply chains, which I think is even more challenging than putting ESG disclosures together. So as far as the SEC, the proposal is broad and at the same time strikingly prescriptive. Some are comparing it to the Sarbanes-Oxley Act. Just to put it into perspective, the SEC estimates that it would take a company approximately 4,000 hours to comply with the proposal. Massive undertaking, right? Especially for smaller companies. Should the proposal be finalized by the year end, which the SEC continues to say that they're working towards that objective. So should that occur, the first group of companies, large accelerated filers, would be subject to reporting for the year 2023 in the annual reports that are filed in early 2024. Then accelerated and non-accelerated filers would be phased in a year later, and then smaller reporting companies would have an extra year. There are also third-party verification requirements for larger companies, starting with limited assurance, which is, I suppose, comparable to the review of the quarterly reports, and then moving to reasonable assurance after that. So the SEC has received approximately 14,000 comments on the proposal, including some comments from companies and trade organizations on the most burdensome aspects of the proposal. And those include 1% reporting threshold for climate impact on the financial statement line items. And that's important because that's in the notes to the financials, right? So that would be subject to the regular audit right away. There were comments expressing timing concerns because normally it takes much longer to put the ESG report together than the time that the annual report on the Form 10K is being filed. There were concerns about burdens on supply chain and particularly smaller companies. Some comments about the board climate expert that we were talking about. It's not required by the rule, or at least it's not substantively required, right? But their company would need to make a disclosure whether or not it has board climate experts, so that's impacting those decisions to some degree. And then, of course, a lot of comments on the Scope 3 reporting. As proposed, Scope 3 reporting would be required for larger companies to whom Scope 3 is material, or they include Scope 3 in their targets.
And
Courtney,
Yogita, I will say that the society actually put out a comment letter and an amended comment or a follow-up comment letter as well on this that sort of summarizes the thoughts of the member companies and is not nearly as long as the proposal, which is, they're both good reads.
good point, and like really great arguments too. It was a pleasure reading that one. I think it addressed the numbers concern quite well. It's expected, widely expected, that the SEC's proposal will be, the SEC's climate disclosure rule will be challenged when it's finalized. It's also expected that the major questions doctrine that was used in the US Supreme Court recent EPA case will be part of the argument against the SEC's authority to enact this rule. Now, there are some differences. The proposal has some materiality requirements, so it's not necessarily it's definitely not a given that it would come out the same way as the EPA case did. So with that said, ESG is definitely not going away, right? So we have ESG coming at companies from all sorts of directions: investors, rating agencies, customers, regulators, etc. So I don't think we can just sort of decide to wait and see, generally speaking, because it takes a long time to put an ESG program into place and to sort of implement all those policies and processes. I think in the meantime, it's particularly important to put processes in place for identifying, collecting, and verifying ESG data. And that can include everything from tie-out binders to software solutions, from disclosure committee review to audit committee or other board committee review. I mean, it would usually include ESG controls matrices, so like some sort of mapping. So a lot of work to be done there. And I think, and Courtney.
Yeah, I would also say, you know, we have an ESG executive committee. We have a working group that's under that committee that then, you know, it serves the basis of what gets reported up to the board on an annual or semi-annual basis, depending on what's going on. The other interesting thing is that, you know, this proposal is extremely, I will say, far-reaching, like you said. But the one thing that, in addition to what we're doing, just because we want to be a good company, our clients, our customers are demanding a lot of information, as are investors, less so for the investors, but we're having to provide a lot of data to our customers. So we're doing a lot of activity in regards to that, because our scope 3 is their scope 1 and 2. So, you know, that's also a bigger driver, frankly, than the SEC's proposal right now.
And it's a really fair point, because even looking at the commercial contracts, we increasingly seeing more and more ESG related provisions. So whether it's like, you know, whether it's just incorporating the supplier code of conduct, or in some cases like going much further than that, requiring climate reduction data, greenhouse gas emission reduction data, requiring climate commitments, asking for the information on commitments relating to human rights. So there is definitely like much more sort of contractual and the procurement process activity as well. Well, I think everybody would very much like to have one standardized standard throughout the world. So Courtney,
Yes.
can you tell
Absolutely.
us ISSB?
So, sorry, yeah. Matt talked about a lot of the acronyms in the EU, and we've got quite a few all over the world. I really do enjoy this chart because, you know, for those of you who aren't familiar with the ISSB, it started with the Value Reporting Foundation, which even before that was SASB and the Integrated Reporting Framework combining. So if you look on the right-hand side, you kind of see how that all came together. And then it's combined with the Climate Disclosure Standards Board, which the CDP is in there. So it's all interrelated, and to the extent we can simplify the alphabet soup that is out there and have one integrated framework, I think everybody from companies to firms to whomever will appreciate that. And it would be a huge step to have one reporting standard, or at least a unified approach, because investors look at different things, and when we're considering, do we focus on Sustainalytics scores or, all of these others, you look to the different investors that you have. But if there's more integration and more unification, it's a lot easier in determining where to spend time and money and what to look for when you're thinking through your internal program. And as far as the SBTIs go, which we can talk about, which is on the next slide. So SBTI, Science-Based Target Initiatives, it's a nonprofit company. It's a global business. They're setting emissions reductions targets. It's voluntary. Companies provide the data, they do an independent assessment and validation, but it provides rigor and it gives third-party validation to what the company is doing. And so, we are in the middle of this process. When we started out on our journey with Scope 1 and Scope 2 greenhouse gas reduction targets, we wanted to do it in alignment with the Science-Based Targets initiatives, just to provide that extra rigor. So it is quite the process. The process is you put out your reduction targets, you apply to the Science-Based Targets initiatives for them to be able to review your data. And it's a very specific process. They have a huge waiting list. So, we have a date sometime in 2023 when they're going to look at our data and review for approval or non-approval. So right now we're saying we're setting it in alignment with the SBTI, but we can't say that, we've been approved until the SBTI approves us. Now, in order to do this, you have to have Scope 1, Scope 2, and Scope 3, which plays into the SEC's proposal because, they say if Scope 3 is material or you're already reporting on it. Well, if you're doing SBTI, you're going to already be reporting on it because you have to get the approval from that body. So it's an interesting dynamic from that perspective, but it is based on rigor and validation, which is helpful.
And then to the extent that you're committing to the Scope 3 science-based targets, right, you probably have to think about how you're going to run that through your supply chain too, which I think is probably one of the main reasons that's driving those contractual provisions and customer commercial contracts, right? Because before we just used to see the ones that say like, provide us your GHG data, provide what your targets are. And now some of them are saying, you as a private company or smaller company, you go ahead and set your own science-based targets in accordance with this initiative. So a lot of activity there.
There is, and you've got to really work with the supply chain group. And in this environment, the supply chain groups are getting hit hard, and they're having to manage just normal doing business and triaging the issues going on, along with now, okay, we need to add in a sustainability piece and work within our own supply chain to hit targets, to collect data. So it's a bit of a back and forth.
Huge undertaking, and it takes us really well into our next topic. So up to now, we have been talking a lot about ESG disclosures and sort of various regimes under which the companies have to provide ESG disclosures. What I think is even more difficult and even sort of more time intensive is building out the due diligence processes for ESG. So we have a bunch of ESG due diligence pending or in some cases even existing regulations in the EU, Germany being one of them, but also we have EU's corporate due diligence directive. So Murph, can you tell us about that and particularly what US companies should know about it?
Yeah, of course. So to begin with, this particular directive is probably the most criticized, politicized, and quite heavily lobbied as well. Pieces of legislations on ESG presently. To set the background as well as set the scene, I would say, and based on all of the impact assessments, I can say that this is probably the most least mature pieces of legislations, because when you read it, I feel sometimes it is even a little bit too ambitious and unrealistic to some extent. And the definitions by itself, if you already start to try to find the scope and definitions of it, they are already quite fuzzy. And when I'm seeing a lot of, when I was one of them as well, who was writing a commentary back to the EU about what we think about this particular proposal text. I think almost every member state had quite a long list of issues to improve and to clarify. But let's talk what is written right now in the current proposal. I do think I can almost assure that it will take quite a bit of time for this proposal to take effect, and also I don't think that it will take effect in the current form it is. So essentially what it is that the directive requires you to, first of all, report on what are you doing and your due diligence measures throughout your supply chain. But it also requires you to take actions actually to mitigate and adapt to any negative effects of it. So who's in the scope? There are very large companies. So when we talk about EU ones, there are companies with 500 and more employees with a net worldwide turnover of 150 million, or companies with more than 250 employees with an X amount of world turnover, who are active in high impact sectors. So those sectors are really under scrutiny by the EU, and those sectors are, I'm just going to read it out. There's manufacturing of textiles, leather, clothing, agriculture, forestry, food production, live animals, timber, wood, mining. So essentially very production heavy companies, obviously. And from the non-EU companies who will be affected, as I put also on the slide in the last one, is that non-EU companies with a turnover in the EU of over 150 million, or there's a little typo, but or non-EU companies that have over 40 million netto and are operating in those high impact sectors that I just mentioned before. So what do you need to really do then? As I say, I don't think it will pass, because it's just the criticism has been as well that we discussed before. It puts a tremendous burden on a lot of SMEs, especially, which will be essentially affected by it, of course. And also to that extent that it actually could be just administratively overburdening. But what do you need to do then? You need to conduct due diligence across your global value chains. It is very broad, and then I'm just bringing out the articles and what has been asked without much clarifications, because the directive
very expensive, right?
Very expensive as well. You need to integrate human rights and environmental due diligence into companies' policies, and also develop due diligence policy, which needs to be updated annually. You need to identify actual and potential adverse impacts to human rights, environment, and all in all activities by itself, and also to its subsidiaries, at the level of and also to the level of indirect business relationships. So I'm not going to go through them one by one because you will get the slides as well. But I'm almost gonna don't think it's that worthy to even go through those very, very strict requirements, because I genuinely do believe that that at the moment the final text will not be like that. However, what the EFRAG is trying to do, of course, as well, and EFRAG is the body who is creating these reporting frameworks for corporate social reporting directive. They're of course taking into account all of the requirements that you have to have under several of those directives and regulations. So just to put your mind into ease, you essentially once you get those reporting standards that EU is approved by the EU, you will get a bit more clarity of what's actually required from you from the supply chain due diligence. What is also very highly criticized, but I don't think actually it will be removed from the text, is that the new directive, it doesn't show really well on the screen, but it introduces penalties. So member states have the right to introduce penalties for non-compliance, but it also creates civil liability of non-compliance, and also director's duty of care and compliance mechanisms, which is something I don't think the EU will remove. So, but of course, from the private sector, they have obviously been criticizing this, that it is quite many requirements, and they're quite worried of not complying with them. But yeah, on that note, I think right now it is still quite the text and this proposal is not mature enough to really take it as the final truth.
Thanks, Mervyn. Sort of a few thoughts on that. So we do have this due diligence directive, right? But even and you refer to that a bit, but even like corporate social sustainability directive, as it's proposed, it's also asking about value chains and various ESG disclosures relating to the value chains. So what that means practically is that you can't really provide that information unless you do have due diligence processes in place to sort of assess where your gaps are, to collect the information, to make sure that you're able to fix things and sort of not have to report a bunch of negative things, right? So just the practical implication. You also talked about the board's role. Again, like I think there are some articles in the news, right? There is some question whether or not this duty on the board for the due diligence whether EU would impose this on third-party countries like US countries, and perhaps not. But even if it doesn't, right? I think you still have to have board processes and oversight in place if you're going to be putting ESG information and the public disclosures. And then there is, so the couple interesting things that always jumps out at me from the key requirements from the directive is, so not only you incorporate them in your policies, right? Not only you set up all these due diligence chains, and there is no like real materiality limitations on that. It's not just your main suppliers, it's like your value chains. But then you also have to mitigate indirect impacts on environment or human rights, and you have to eliminate the actual impact. So it's definitely burdensome. I mean, I think we have seen some reports that some companies are putting aside as much as 20 million to comply just with the EU's various ESG laws. So massive, massive undertaking on that end.
And yeah, that has been also one of the criticism of you know, how far, because like one of the in the proposal text of this directive as well, it doesn't state to what level in your value chain how far do you need to go. So essentially this is one of the key criticisms as well of this vagueness, and sometimes I would just even say being a little slightly utopic in the real world context, but for sure, as you said before, you cannot just ignore the topic anymore because it will catch you.
Yeah, well, and you know, one other thing that's I think frustrating for global companies, it's so let's say we're looking at the EU and we have these EU directives, diligence directive, reporting directive. Well, that doesn't encompass everything just at the EU level either. I mean, just a couple weeks ago, right, there was a forced labor forced labor regulation that was passed in the EU. You basically can't import or export products produced with forced labor. So there's like all these regulations and all these developments that are happening, well, maybe not on a daily basis, but happening like really frequently. And the companies need to have ESG programs that are agile enough to track and adapt to them and encompass all of that. So I'll share some thoughts on that too. But before I go there, Courtney, can you talk a little bit about like how you deal with the supply chain and like even the internal organization? Like, do you have legal oversee the supply chain? Does it sit in the procurement, and sort of like how do you coordinate on all of that?
Yeah, so our group does sit in the procurement group, so not directly under legal. However, we have a ton of coordination with supply chain. You know, nothing on a set schedule, but we're constantly looking at, you know, supplier disclosure, ways to improve our supply chain, ESG things that we're going to implement. So we roll things out in a way that's not disruptive but productive, and that is, you know, there's a lot of training that's involved with that as well. And we are a little bit decentralized in that Vontier is sort of a holding company of 6 operating companies, and so we not only train our corporate supply chain, but then we go out and talk to each of the operating companies and their direct supply chain groups. So I will say, just, you know, tons of coordination, and they understand that regulations change and we've got to be agile to change with them, and it's not always easy and it does have to be done. And so, you know, we try and keep an open line between the two, and where possible, I try and help front run any of the issues.
Yeah, but as you said, Jurgita, it's almost very interesting to see, you know, countries or EU member states that already have those due diligence regulations within them. How will they be shaped in the light of this directive? And also, it's very interesting to see because, like in the UK, I think probably the most like practical example is where it has been already implemented for some years, which is the UK, that has the modern slavery statements that companies need to you know, comply with, and you have very strong financial and also criminal offenses if you do not comply with it. So obviously UK is not within the EU anymore, but I'm pretty sure and certain that they are still doing business within the EU, so they will be affected with it as well. So it's very interesting to see how those current acts and regulations will be amended in the light of this directive.
Yeah, if this is not adopted or not adopted as proposed, I mean, there's continual and increasing regulation. So that is something companies need to expect.
Yeah, I think the turning point probably was in the consciousness was that Rana Plaza tragedy that happened, which I think really woke up the regulators, at least in the EU, because many companies who the parents were from, let's just say, from the EU.
Yeah, and like I'm really glad that you mentioned the EU modern slavery statement too, because we have California's Supply Chain Transparency Act. So it's different in a way that it requires disclosure of what the company does. It doesn't really require the company to put due diligence into place. But now with like so much more scrutiny on greenwashing and so much more scrutiny on ESG disclosures in general, I think at the minimum it's important to take a look at that statement and see that it's accurate, that if you're actually saying that you're doing certain things, that you are doing them. But then more than that, to actually think about putting those due diligence processes in place. And then sometimes, like when resources are limited, we think like how do you scale this down? Like how do you put something in place that works? So couple ways to get started on that, right? So like you can try to limit it to your hot areas or your most critical suppliers, maybe larger suppliers by the revenue or somebody who you couldn't do business without. And then if you look at, it's not a regulation, it's sort of guidance from the US customs agencies, but there are already like sort of due diligence suggestions. Suggestions is probably too soft of a word, but basically due diligence guidance in the forced labor area. That's sort of similar to the EU's due diligence directive, or there is like a fair amount of overlap. And so starting with possibly forced labor, it might be a good way to develop those systems and those processes that then can be applied to other areas as well. And I guess one other thing is like many companies have like really good anti-corruption policies. We have been doing this for a very long time. So in a way, like if you look at those, maybe this forced labor and all these other ESG things, that's something that can be built on top of that.
Yeah, and that actually made me think, because that sort of falls more within our compliance team, the anti-corruption policy, which is different from the supply group, but it just goes back to everybody needs to be working together.
Lots of coordination. And I liked how you mentioned that you're a holding company and you have all these subsidiaries, right? Because I think one question that a lot of companies are facing, even like, how do you deal with your ESG disclosures? I mean, a lot of times it's probably impractical to centralize that and to send like every marketing material to your central office, and like what sort of training you do at your operating company level.
Yeah, we haven't released our first report yet, but we're working on it. It's going to be from the corporate perspective, but we do training for each of the opcos, and as part of sort of the ESG working group, we've involved people from each opco that are marketing and product people that are, the most impacted or might have the most helpful information. Because a lot of what we're interested in too is, what are we already doing that we don't know we're doing, but that falls sort of under the ESG umbrella that's great to capture.
Yeah, well, a lot to do. So with that, Courtney, do you have any takeaways or like things that the company should in particular be thinking about?
There's so many. I will say, when you leave this conference or this webinar webcast, the one thing is just to sort of look holistically at where you are, what you're doing, how involved the board is, and be thinking about either what you need to put in place eventually, in the next 6, 9, 12 months, or what you have that's great that you may not be touting that you have, but that you should to the board. Because I think every board member is going to start asking for metrics if they're not already.
And getting credit if you're doing great things, disclose them publicly and
Yes.
get credit, right? Especially on these like ESG governance structures. Sometimes I think it's like such easy thing to get credit for, and sometimes companies don't. But thank you, Courtney. Like great takeaways. And Murph, I know that you had a few to share as well.
Yeah, so as we've discussed, it's pretty, I guess, may I use the word intimidating, or makes at least a head spin of what the EU is planning and proposing. But and the midst of that is essentially just start preparing, and really start preparing really sooner than later, because as you've seen, it's not only e-data, it's ESG, and there's due diligence requirements that you need to put in place. So really start right now, even though the dates, especially for corporate social reporting directive, might be far off, that you only need to report already in 2028 financial year, but the dates appear closer than they the dates are closer than they might appear. And of course, start collecting the necessary data. Of course, depending on how big you are, but and the maturity levels of your ESG strategies within the company. But as you can see from the European point of view, you have lots and lots of data sets to collect, validate it, assure it. So start doing it already now. And I think from the EU side, and what I've realized as well, the lack of data is the biggest issue and the biggest problem at the moment. And it's really, sorry?
Same in the US. I think
Yeah.
that action and verification. We did the study probably about a little bit more than 6 months ago now, and that's definitely an area that pretty much every company identified.
Yeah. And it really isn't just a kind of technical exercise or box ticking exercise, as you've seen, because it really requires involvement from senior management and the board, as especially when we've seen from corporate social due diligence, corporate social reporting directive. You need to think it from the double materiality point of view. You have to really think through your company strategy forward wise as well. And so in order to look, obviously do the right thing, but also look appealing to your investors and public and your other stakeholders, is really necessary to do it together. And on that side, of course, mapping out and involving the relevant internal and external stakeholders is also important. And I guess what I can just want to say as well is, like, as Courtney also mentioned, that there's a variety of reporting standards. There's still quite a bit of confusion of what do I need to report and in what format, and how to really do it in a smart way that it will benefit also, that you don't need to redo it or restructure it in the years to come later. So I would really recommend to especially the teams that are working on these ESG reporting measures, to really dive deep and have some quite long nights to figure out what are the suggested and best frameworks. And I guess what I just want to mention is that what gets measured gets managed. So we are in the new era, and ESG is here to stay, and it doesn't really seem like that it's going to slow down anytime soon.
Yeah, great points. And just one thing to add to that is, I think if resources are really limited and you're thinking where to get started, one thing that we sometimes suggest is, like, think about it taking an incremental approach, right? Because For example, like SASB and TCFD are the building blocks of many of these proposed regulations. Now, the proposals are broader and there are some differences, but like if your company is not reporting in accordance with SASB and TCFD yet, that's often a good place to start. And same goes for the greenhouse gas protocol for measuring greenhouse emissions. And then, of course, putting processes in place, identifying overlapping areas on the supply chain, and also putting processes in place for ESG data and controls. Well, it was a very informative panel. Thank you to Courtney and Murph for their insights, and thank you to everybody for joining. The next Ohio chapter events, we are planning a get-together in Columbus in mid-November, and to be followed by a webinar or hybrid meeting on proxy developments in December. So I hope all of you can attend. If you have any questions or suggestions, please let us know. And with that, thank you to everybody and have a great day.